Nitin, are pressures building up again for the market? Because it looked for a bit that the market's trying to work its way out of that trading range. But do you think we are getting pegged back again?
Morning, Udin. I think definitely, at this point we're right in the middle of the trading zone. So all indications are that we are likely to go down and test the lower end again. Clearly, while one thought that with all the positive news flow from Delhi and initiatives from the government, we might just be getting ready to move out. But what ended up happening was that the light at the end of the tunnel wasn't really the real light. We got hit by the RBI train. So I think we got to do some more work, spend maybe some more time in this zone, and potentially look for the peaking out of the cycle before we can actually start getting out of this.
Nitin, morning. Is that your sense of how the rest of this year will probably pan out, that the market will slowly drift to the lower end of the range and will mostly putter around in that area?
Well, one doesn't know if it's going to be slow or fast, but definitely I think the 53 to 57 range is what looks like the best case scenario for us right now. I mean, the world around us is definitely looking very, very bleak. One wouldn't have imagined, 6 months ago or even 3 months ago that, there would be serious talk about US downgrade and default, and the lawmakers there would definitely, let this get to a brink point that it has already gotten to. So I think, we're definitely looking at a very, very bleak scenario if something like that happens, even though it's still being seen as unlikely. Not that we didn't have enough problems with Europe from a global macro perspective. So I think definitely the best case scenario for us really is to stay in this zone and hopefully not break it on the downside either. And then definitely we have a lot of local headwinds that one needs to contend with. The RBI stance has been fairly hawkish. It was much more hawkish than anybody expected it to be. And everyone's revised their targets upwards of where RBI might be stopping in this tightening cycle.
What's the bigger challenge for the market, Nitin? Is it the global turbulence which has cropped up again, or is it the local macro and the local problems which just till 10 days back everybody thought, or almost everyone thought, was in the price, and one need not factor it into valuations or prices any further?
I think it's really about picking the lesser of the two evils, but definitely it looks like that once we get through with some of the domestic issues, we might have a better time. But again, we can't look at that in isolation because we have such a strong linkage on capital flows with what's happening around the world that any global capital shock will obviously drag us down fairly significantly as well if that happens. So I think I don't think we can choose one over the other because they're all so tied in together anyways. I mean, inflation is in large part a result of what's happening globally as well. But I think one thing is very clear, that even if there is everything calm on the global front, until we resolve the interest rate cycle and the inflation issue here, I don't think the market will actually have any firm feet to start climbing significantly, even though you will find very, very interesting investment opportunities being thrown at you over the next 4 to 12 weeks, primarily based on what might happen.
So far, Nitin, selling has not exacerbated an already difficult situation for the market. Is it your sense that we may remain relatively steady compared to the rest of the world, or do you think the market should prime itself for some serious outflows as well?
Again, at this point in time, it doesn't look like that we're going to look for serious outflows, or that might only happen if we get into a really bad situation globally with the US downgrades and so on and so forth. Obviously, at that point in time, capital flows will get very hard to predict, even though one has to only imagine what a safe haven for investment will be at that point. So I don't think we're looking at significant outflows. Most fund managers and global investors that we talk to, their view is that they don't have conviction to put more money to work, but they're definitely not looking to get out of India at all. I mean, they've already spent a better part of last 1 year bearing the pain, and at this point, there is very little incentive for them to sell at these levels and these valuations. So I think, as I said, the best case scenario really is that we basically go through this time correction a little more, and at the right time, when the cycle seems like it's peaked out, we definitely get some fresh inflows, because I think we're due for that anyways.
Nitin, the big question is what you do with the banks, both in terms of what they can do, on a performance parameter, and what may happen with asset quality going into the next couple of quarters.
I think that's an interesting question, because one view is that their interest margins have probably bottomed in terms of the compression that had to happen because of higher rates. But on the other side, I think the valuations are also fairly interesting. Maybe not so for the frontline, large cap private sector banks, but definitely so for a very large pocket of the PSU banks. So I think if you take a slightly longer term view, and if you think you can buy in 4% dividend yield stocks at or below, price to book 1, then I think you're really setting yourself up for some very significant upside, as the cycle turns. I think the concerns on NPAs are a little overblown, barring asset quality of maybe one or two specific cases in banks where we've had historical problems. But I think overall, this is definitely a time to start focusing on where you see a lot of value. And even some of the private sector banks that have reported numbers already definitely have surprised the market on the upside. So I think with the bottoming out of the margins, with potentially valuations being fairly attractive, I think it's something that's very compelling from a long-term perspective.
Nitin, how do you approach a name like BHEL? I mean, there seems to be a lot of pessimism after the results there.
I think first Crompton and then BHEL definitely has put a lot of negative focus on the capital goods space per se, even though I think the BHEL management believes that there was a one-off issue that actually caused a delay in some of the numbers. But I think overall the environment is pretty harsh, especially in areas where interest costs have been hitting them hard. So I don't think in the very short run one can expect any quick turnaround in the sector per se, but let's wait and watch for what L&T tells us and see whether this is a company specific issue or we can kind of assume that the whole sector is in the same boat.
Nitin, do you see the interest rate sensitives dragging some more, because they seem to have got shocked the most by the RBI policy, but do you see material price downside in autos, banks, real estate, infrastructure from here?
Again, I think it's not probably the same brush that you can paint all of those sectors with that you named. Clearly, the real estate, construction, infrastructure packs definitely feeling the most pain right now. Even banks are feeling a lot of that pain. Autos, I think, clearly the numbers, at least the quarterly results for things like Maruti showed a very different picture. But they'll definitely start feeling the pinch on demand side, because that's what the RBI is intending to do now. So clearly, I think they're not out of the woods yet. Interesting investment opportunities coming up as the downdraft continues. But from a short-term trading or a movement perspective, I don't think one can bet on the pain being over.
Of the more than 300 bits that the RBI has hiked so far, Nitin, interestingly enough, 125 of that has come just in the last 3 months. What are the chances the market has not got a clear handle of how much earnings deceleration we may see over the next couple of quarters?
I think it's actually it can cut both ways. One, RBI obviously went from trying to focus on supply to then now focusing on slowing down the demand, because I think there is only so much that can be done on the supply side in the short run. Has the market completely discounted the impact, or has the impact actually been fully felt in or trickled down into the real economy is a big question. Based on at least what we are seeing in the current quarter numbers, I don't think one can actually assume a much more bleaker scenario than the market's already assuming, even though the latest 50 basis point hike obviously will mean a certain more downward revision of the numbers and earnings. So I'll be very surprised if at the end of this earnings season we don't see at least some impact of the downgrades being put in place for FY12 at least. But again, I think that's a little bit in the prices already.
Nitin, where do you stand on Fmcg, and is there a case to be made for even further price appreciation from here?
Again, I think as Udayan mentioned earlier, earnings will probably not surprise on the downside. If anything, they'll give a lot of people a lot of comfort. Valuations definitely look stretched, but in this market, where else will you go? Unless you go into branded consumer goods and services, which is where most of visibility on earnings seems to be intact. So I don't think, at least in the very near term, one can expect anything but flight to safety again to these names, and hence, one might not get any significant cut in these stock prices.